All right, welcome back everyone. Today we're going to be diving into chapter 7, which talks all about production and costs. So in this chapter, we're going to be focusing only on the behavior of our firms or our businesses. And in this class, we already talked a lot about what a firm is. A firm is just some entity or institution that is taking some inputs, those factors of production, land, labor, capital, and raw materials, and they're turning that into some output, into some good or service. And so when we talked about our circular flow model way back in the beginning of this class, we know that firms in our market for inputs are the buyers. They're buying those factors of production from our households. And they do that because they want to produce some product, right? They want to produce their good or service so that they can make some money. So when we're talking about production, we want to know more about how businesses decide what to produce and how much to produce. Then we're thinking about these production decisions that businesses make. We can summarize these production decisions that are made by firms into a few key questions. First, a firm has to decide what product it's going to produce. So it's going to decide what good or service it's actually going to produce. Then it has to decide how it's going to produce it. So this is, looking at what inputs the firm is going to use and what specific production process the business is going to use. So how many workers do we need? What kind of equipment do we need to buy? What kind of raw materials do we need? How much space do we need to produce? So this question of how to produce is what inputs or what technology are we going to use to produce our product? Then a firm is also going to look at how much to produce. So what quantity of output should the firm produce? And then lastly, the firm also needs to think about how much this product is going to cost its consumers. So the firm is also going to try and answer this question of what price they should charge for their product. Now, if we want to think, all right, here's all of these production decisions that a business is making, how does it answer these questions? And so, of course, a key factor here is going to be costs, right? When a firm is deciding what to produce and what kind of inputs it's going to use to produce that product, it's going to care a lot about how much those inputs cost. Then, when it's deciding how much to produce and what price to charge its customers, it's going to take a look at its costs, take a look at how much it can earn from selling its product, and it's going to try to create some balance between the two so that their earnings are greater than their costs. The last thing a firm is going to consider when it's looking at all of these different production decisions is the structure of the industry or the market structure in which it's operating. So essentially, a firm wants to know how competitive this industry is. How many other businesses do they have to compete with? How much power or influence do those competitors have in the market? And how unique is this firm's product compared to the product sold by all of its competitors? So this factor of market structure or how competitive an industry is will come up later in this class as we start to discuss some different types of market structures. So to begin our discussion in this chapter, we've already talked about what a firm is and all of the production decisions that a firm is facing. But why does a business want to produce anyways, right? We know businesses want to produce and sell a product so that they can earn some money. They want to make a profit. And so now we're going to talk about what profit is and how economists measure profit. So profit is just defined as the difference between a firm's revenue and its costs. So this is just the money that's left over from producing and selling some product after a business covers all of its expenses. So revenue is the raw earnings that a firm receives when it sells its goods and services. Costs is the amount that a firm has to spend in order to produce and sell its product. So when we want to calculate profit, we're just going to take our revenue and subtract our cost. If it's positive, that's great. We earned some profit. We had some money left over after we produced and sold our products. If our profit is negative, then we're not so happy, and we're going to call that a loss. That means that we spent more than what we earned. Economists use the Greek letter pi in order to represent profit. So you'll see this a lot from here on out in the class, but our formula for calculating profit in its most basic form is we're just going to take revenue, subtract cost, and that's going to give us our profit. So in its most simple form, when we're trying to calculate profit for a firm, we're just going to take their revenue and subtract from that their cost. But as economists, we have a couple different ways of looking at costs, and really we've already talked about this. So we can divide up the costs that are faced by a business into two categories. We can have explicit costs and implicit costs. Now, explicit costs are costs that are very easy to identify. These are our tangible, out-of-pocket expenses that are showing up on invoices, taxes, receipts, things like that. Now, explicit costs for a business might be things like the wages that are paid to employees, utility bills, the cost of any equipment, rent. But implicit costs, which are of particular interest to economists, are our opportunity costs. So if I decide to open up a pizza shop and I spend $50,000 getting my pizza shop all set up, renting out the building, buying the pizza oven, hiring my employees, getting all of my ingredients, my explicit cost to run the pizza shop is that I've spent that $50,000 to buy all of the inputs that I need, right? But my implicit cost, or my opportunity cost, is whatever I'm missing out on by choosing to spend that $50,000 on my pizza shop. So if I didn't spend that $50,000 on my pizza shop, maybe I could have invested it in the stock market. Maybe I could have used all of my time to go work somewhere else where I could have earned more money. So for economists, we care about both these explicit costs and these implicit costs. And depending on which types of costs we're considering, we can actually create two different definitions for profit. So depending on which costs we're considering, we can calculate profit in two different ways for any firm. So if we're only considering these explicit costs, these tangible out-of-pocket costs for our inputs, then what we're calculating is actually something called accounting profit. So when we're talking about accounting profit, we're still going to use this Greek letter pi to represent profit, but we're going to put this tiny a next to it just to denote that this is accounting profit. And so accounting profit is calculated by taking our revenue and subtracting only our explicit costs. Accounting profit in the real world is typically used for things like taxes. So when you go to an accountant and you need to get your business taxes done for the year, your accountant is only going to look at this accounting profit when they're deciding how much you owe in taxes. But for economists, we want to look deeper than that. We want to consider your explicit costs, but also these opportunity costs that a business might face. So we want to calculate the economic profit. So we're going to call this pi with the e next to it to denote economic profit. And to calculate economic profit, we're going to start with our revenue. And from that, we're going to subtract both our explicit costs and our implicit costs. So when we calculate economic profit, we're not just looking at the difference between earnings and all of those tangible expenses. We're looking at the difference between earnings and all of the costs that the business has experienced. So by throwing in these implicit costs or opportunity costs, we're able to better measure the true cost of operating a business. Would it be more profitable for this firm to move into another industry? Is there another way that this firm could use some of its inputs that might earn it more money? When we think about adding in these implicit costs, we're able to measure that as well. If you're curious about what the implicit costs faced by a business might be, usually these are things like opportunity cost of the business owner's time, the opportunity cost of using some equipment to produce a certain product, or the opportunity cost of any investment that has been made by the business owner. So if I decide to open up my own small pizza shop and I'm spending a lot of hours working in this pizza shop, every hour I spend working in my own business, I can't spend working somewhere else. So I can measure this opportunity cost of my time in terms of the wages that I'm losing out on by choosing to work for my own business instead of choosing to work somewhere else. I can also measure the opportunity cost of some piece of equipment. Let's say I buy a nice big pizza oven for my pizza shop. Let's say I buy this pizza oven, it costs me $20,000. And if I choose to use the pizza oven, I've already paid for it, I'm good to go. But instead of using the pizza oven, I could turn around and resell it. So whatever that resale value is for my pizza oven, that is my implicit cost or my opportunity cost of continuing to use it in my own business. Now we're going to move on and we're going to talk about production for a business. We want to create a simple model of the production process that is used by a firm. And we're going to do this with something called a production function. So all this is just like a function in math. When you have a function in math, you take your input, which is usually x, it goes through your function, and it spits out your output, which we usually call y. And so when we're talking about a production function for a business, all we're going to say here is that the business is taking in some inputs. Those factors of production are land, labor, and capital. It's going to feed those through its production process, where those materials get used up, or they're combined in some way to create the final product. And then, of course, the output is the good or the service that the firm is producing. This production function is just a model that's describing the relationship between inputs and outputs for a firm. Now, when we're talking about production for a firm, we can break this into two separate discussions depending on the length of the time period that we're analyzing. So in the short run, a business is going to have less flexibility in terms of its production. What this means is just that the firm is not going to be able to adjust or alter all of its inputs with a whole lot of ease in a very short time period. So we can imagine that I open up a fast food restaurant, a burger restaurant, and in the very short run, I can't just magically expand the size of my restaurant, right? So I open up my one burger restaurant. Let's say that I have, 2 cash registers. I have a couple chairs and tables in the restaurant, but the restaurant is a fixed size, right? I can't just snap my fingers overnight if the restaurant gets really busy and double the size of my space. So in the very short run, our capital, buildings, equipment, things like that are fixed, or the firm is not able to easily adjust the amount of capital that it's using to produce. However, labor is much more flexible, right? In the short run, at my burger restaurant, I can choose to hire and fire workers as I please. So when we talk about production in the short run, we're going to assume that capital is fixed. It's not very easily changeable, but we'll assume that labor is changeable. Labor is variable. All right, so whenever we're talking about a firm's production in the short run, we're going to assume that capital is fixed or that it can't be changed. So in my burger restaurant, over a very short period of time, maybe a couple days, a couple months, I can't magically snap my fingers and expand the size of my restaurant. If I wanted to install any new kitchen equipment, that's going to take a really long time to find the space for it and get it installed. So we're just assuming that capital is fixed in the short run. So I'm running this fast food restaurant. My output that I'm producing are burgers or meals for my customers. And the only way that I can alter the quantity of burgers that I'm producing is by changing the number of workers I have. So over on the right here in the table, I have some information about how many burgers I can produce, my total output, depending on the number of workers that I hired. So when I have 0 workers, I can't produce anything. But as I gradually increase the number of workers that I have, my total output, for the most part, is increasing. I can use this information to plot my total production function in the short run. So when I have no workers, I'm not producing anything. So I'd be way down here at this point. That first worker is going to help me to produce 5 units of output. That second worker is going to get me up to 15 units of output. My third worker gets me all the way up here to 30 units of output, and so on and so forth. All right, so if I finish up plotting my information in the table to create this short-run production function, this is the graph that I'm left with. So this kind of hill-shaped black line here is my short-run production function. So initially, as I continue to hire more workers, my total output is increasing. I'm happy. But eventually I reach a point, if I choose to hire this 7th worker or this 8th worker, where my total output is actually falling. So if my goal as the owner of this fast food restaurant is to produce as many burgers as possible to hopefully maximize my profits, then I want to choose to produce at the level of output that is right up here at the tippy top of my production function. And so in order to do this, I'm going to want to hire 6 workers. So if we look at the table, my output is maximized when I hire 6 workers at 48 burgers. But we can also look at this problem from the perspective of marginal product. So what we want to analyze here is something called my marginal product. So marginal product is the change in output that's associated with one additional unit of an input. And so specifically, if I'm talking about changing labor, then what I'm looking for is the marginal product of labor. If I hire one more worker, if I get that one additional unit of labor as an input, how is that going to change my output? So how many more burgers am I going to be able to produce if I hire one more worker? And so that's the question we want to answer. As a firm gradually hires more and more workers, as I gradually hire more and more workers for my burger restaurant, how is my output going to change? Okay, so let's imagine that my fast food restaurant is starting and I have just one employee, I have just one worker. So this one worker is going to be spread pretty thin, right? This means that the one worker is having to take all of my customers' orders. This one worker is having to cook all of the food. This one worker is having to clean all the tables and clean the rest of the restaurant. So, they're just bouncing around and running around trying to get all this stuff done. So if I decide to hire that second worker, that's really going to help my workers to produce more, right? So the marginal product of hiring this second worker should be very high. Now I have two workers and they can split some of these tasks between one another to make themselves more efficient. So maybe one worker stays in the kitchen and they cook all of the food, while the other worker takes the orders and busses the tables. Then maybe I hire a third worker, and now my workers are benefiting even more from specialization or from that division of labor. They're each able to focus on one individual task, and together that's going to make my entire restaurant more efficient. So the marginal product of hiring this second and third worker should be positive. My change in output should increase a whole lot once I hire these extra workers. So now with 3 workers, I have one worker who's specialized as a cook, one who's specialized as a cashier, and one who's specialized cleaning the restaurant. So seems pretty intuitive, right? As I add more workers, each additional worker should continue to add to my output. But this is not always the case. I could start with one worker. That marginal product for my second worker is going to be positive. The marginal product for my third worker is still going to increase my output significantly. But let's say now I have 10 workers or 20 workers. Because my restaurant is a fixed size, because capital is fixed, it's going to get pretty crowded in there if I hire 20 workers, right? So at some point, the marginal product of hiring that additional worker, maybe going from 20 employees to 21, it could actually start to hurt my productivity. If it gets too crowded in my restaurant, then my employees are getting in one another's way, or there's not enough space for them to work effectively. So at some point, if I have too many workers and my capital is fixed, my marginal product of labor could actually be negative. So let's see how we can illustrate this marginal product of labor now on a graph using some numbers. So we're talking about my burger restaurant or my fast food restaurant, and I'm trying to decide how many workers to hire in the short run. So my capital is fixed because we're in the short run. I can't snap my fingers and change the size of my restaurant overnight. So if I want to produce more burgers, I'm going to have to hire more workers. And I want to decide how many workers should I hire if I want to produce as much output as possible, if I want to maximize my output. So in this table, we have some information that's just telling me, depending on how many workers I have, how many burgers I can produce per day. So if I have 0 workers, I can't produce anything, right? If there's no one there to cook the food, how can I make it? But if I hire this first worker, now I can serve 5 burgers a day. Not great, but it's something. It's better than nothing, right? So this first worker is going to help me to produce 5 burgers a day. And what this tells me is that the marginal product of labor for this first worker is going to be the 5 additional burgers they help me to produce. Now, if I want to hire the second worker, I want to make sure that this second worker is actually going to add to my production, right? And lucky for me, that is the case. So I hire the second worker, my number of burgers sold per day increases from 5 to 15, so I'm happy. And the marginal product of labor for the second worker is just the change in my output that's caused by this second worker. So my output goes from 5 burgers to 15 burgers, So my marginal product of labor for the second worker is 10. I can keep going along in this table, and I'll see that if I hire the third worker, my output is going to increase even more. This third worker is giving me a marginal product of labor of 15 burgers. So in these early stages of hiring, my business is benefiting from specialization and the division of labor. Each additional worker that I add or that I hire is adding more to my total output than the worker that came before them. So as I start to add more workers, my business is just becoming more and more productive. And so if I want to plot this on a graph, I'm going to be creating what's called the marginal product of labor curve. So as I start to hire more workers, my marginal product of labor, at least in the very beginning, is increasing. Now, I can keep looking at the information in this table. I can use it to calculate my marginal product of labor. And what I'm going to see is that when I hire this fourth worker, my output still increases, and the marginal product of labor for this fourth worker is 10 burgers. If I want to hire the fifth worker, they're still adding to my output, but they're not as productive as the fourth worker was, right? This fifth worker is only going to add 5 extra burgers to my total output. Then for the sixth worker, again, they're still adding to my total output, but they're adding less than the worker that came before them. So the marginal product of labor for the sixth worker is only 3 burgers. It's the change in output that happens when I hire the sixth worker. So I can continue to add this information to my graph. And what I see that starts to happen here is now my marginal product of labor is starting to decline. So each additional worker is still adding more to my total output than the worker that came. Each additional worker is still adding positively to my total output. Total output is still increasing as I continue to hire up until this sixth worker. But past 3 workers, each additional worker is less productive than the one that came before them. So at this point, when I'm hiring workers 4, 5, and 6, I've kind of exhausted these benefits from specialization and the division of labor. New workers are still helping me to produce more, but my restaurant is getting more and more crowded. Now, if we continue on and I'm trying to decide how many workers to hire if I want to produce as much as possible, I start to run into a problem here around my 7th worker and my 8th worker. So if I'm trying to decide whether to hire the 7th worker, as a business owner, I might be concerned because the 7th worker is actually going to harm my restaurant's productivity. When I hire this 7th worker, now my output actually falls. So the marginal product of labor for this 7th worker is negative. They're actually making it so that I'm producing less. They're getting in the way of my other workers, and they're making it harder for them to produce. Same thing is true for this 8th worker. They're actually harming my overall productivity. And so if I want to plot this on my graph, I'm going to see that my marginal product of labor curve actually goes negative at this point. So it might look something like this. And so as a business owner, we only want to hire workers that are going to add to our productivity. So the rule here is that we're going to hire workers if the marginal product of labor is positive, and we're going to stop hiring as soon as we get to the edge, right before the marginal product of labor becomes negative. This phenomenon that we showed with our marginal product of labor and with the shape of the marginal product of labor curve can be attributed to something that we call the diminishing marginal product, or specifically the diminishing marginal product of labor. All this means is that when we have successive increases in an input, so labor or the number of workers in this example, that those increases are going to be associated with a slower and slower rise in output. So initially, as I start hiring more workers, my marginal product of labor is increasing, but past 3 workers, we start to see this diminishing marginal product of labor. Each additional worker is adding less and less to my total output than the worker before them did. Eventually, this diminishing marginal product gets so bad that additional workers are actually harming my total output, or my marginal product of labor becomes negative. So, in the short run, my business is trying to decide how many workers to hire in order to maximize its output. So I want to hire the number of workers that is going to help me to produce as many burgers as possible. If I'm looking at this from the perspective of my marginal product of labor, I want to stop hiring once I reach the point where if I hire one more worker, my productivity is actually going to go down, or my marginal product of labor is going to go negative. So I'm happy when I'm hiring these first 3 workers. Each an additional worker is even more productive than the last. My output is increasing. I'm still happy here when I'm hiring my 4th, 5th, and 6th worker though. Even though my 4th worker isn't as productive as my 3rd worker, my 5th worker isn't productive as my 4th worker, these workers are still adding positively to my total output. They're still helping me to increase the total number of burgers that I'm producing. So I do still want to hire these workers. However, once I get to this decision where I'm deciding whether or not to hire this 7th worker, that's when I'm going to stop hiring. My total output is maximized at 6 workers. My marginal product of labor becomes negative if I choose to hire this 7th worker. So I'm going to stop. I'm going to hire 6 workers, and that's how I'm going to maximize my output in the short run. All right, so why do we have this diminishing marginal product of labor? First off, this happens only in the short run. So when capital is fixed, the only way we can affect our production is by changing the number of workers that we hire. And so initially, as we hire more and more workers, we're benefiting from specialization and the division of labor. After a certain point, we've exhausted those benefits from specialization, and these workers are just competing with one another to use the limited amount of capital that we have. So workers eventually start to interfere with one another and actually slow down the production process.